Hey guys, my name is Mike Boyd, this is The Money Flare, and in today's video I want to go over another chart. And this time it's about home prices, which is not something that I've covered on the channel before. Now, I'm definitely not an expert on real estate by any means, but I am someone who follows markets closely, especially the macro factors, the big picture trends of interest rates and the dollar and the business and credit cycles. And real estate is not separate from the macro economy as a whole. It's very much tied to interest rates in particular. So with that out of the way, let's get into the chart. In red are home prices in the US, and in blue is the rent component of CPI, known as owner's equivalent rent. It's basically just a gauge of the cost of rent. This chart only goes back to 1990, but if you went further back, you'd see the same relationship that you saw back then, which is that historically, home prices and rents have been in line with each other over the years. And that's because they both have gone up with inflation. Based on Case-Shiller home price data going back to 1870, home prices in the US have usually kept up with inflation, and that's about it. So the real return on homes has been close to 0%. The real home price has been very steady for most of history, as you can see on this chart. The blue line of home prices have essentially gone sideways since the late 1880s. There was a major dip during the Great Depression, but overall the trend has been sideways. And it's only recently where we've seen such large home price appreciation. So back to the first chart. What's clear is that home prices and rents have been in line with each other over the years, since both tend to increase at the same rate of inflation. But that changed in the early 2000s, leading up to the housing bubble in 2008, where home prices and rents were severely decoupled. After the bubble popped, home prices came back down to fair value according to this relationship, but soon after that they started to diverge again. Here's an updated chart with the current relationship between the two, and here rents are in green. Now, the COVID crisis and the lowering of interest rates combined with a surge in demand and low supply of homes caused the largest year-over-year increase in home prices in over 30 years. Just look at how crazy the chart looks. It looks like the price of lumber or natural gas or even Dogecoin. And so now the gap between home prices and rents is as big as ever. In January 2006, the gap between prices and rents at the peak was roughly 40% with respect to the long-term trend. And in 2021, that gap is back to 36%. Now that could mean that there is more room to run, but we are definitely getting into stretched territory. Now, what does this all mean? How should we interpret this chart? And believe me, it's not the most obvious. Sure, you could say that home prices are in a bubble similar to 2008, but that doesn't mean that we'll see a crash tomorrow. There's also nothing stopping this gap from diverging even more. But if we were to assume that this long-term relationship between home prices and rents will eventually hold, then it suggests that either home prices need to come down, rents need to go up, or a combination of the two in order to resolve this correlation that has historically held for a long time. And while I do think that rents will go up, there is a limit to how much rents can go up. And so this gap won't be filled without home prices coming down, at least to some extent, or at least staying steady for some time to allow inflation to catch up. It's important to remember, though, that home prices are very correlated to interest rates, because at the end of the day, people don't buy homes. They buy a 30-year payment plan we call a mortgage. And so the interest rate on the mortgage is the determining factor for how high a price people can afford. As long as the monthly payment on the mortgage doesn't increase too much, then it's fine, and home buyers can continue to afford higher and higher prices. This is exactly what has happened over the past 30 years. The environment of decreasing interest rates has fueled this massive appreciation in home prices. And this is supported in the data. If you plot home prices along with median income and the average monthly mortgage payment like I have here, you can see the exact same dynamic as I mentioned earlier. Higher home prices have been supported because mortgage rates have come down over time, and the monthly mortgage payments have been in line with median income, suggesting that a 30-year mortgage on an expensive home is still very affordable due to low mortgage rates. Now, that wasn't the case in 2008, and maybe that's why we had a crisis back then, but that is the case now. And so, as I said in my previous video on inflation, the key variable to watch going forward, in my opinion, is interest rates. If mortgage rates ever increase, we could see home prices get affected. And I think it's safe to say that we're clearly in a bubble, but every bubble needs a catalyst to pop it, and a sudden increase in mortgage rates would be an obvious one. And there are others for sure, but I'm definitely keeping my eye on rates. Now, for anyone looking to buy a home soon, I'm not saying to sit out and wait for the crash, because it may take longer than you're willing to wait, and it may not even happen either. Case-Shiller data from the Netherlands since the 1500s shows just how long a housing bubble can last. From 1952 to 1810, Amsterdam real estate was pretty steady. Prices kept up with inflation, and so the real return on homes was zero, exactly what the past 100 or so years of US home price data would suggest. But the city had three epic housing bubbles during that 228-year period, with each one lasting multiple decades, sometimes 30 or 40 years. The real estate market was very different back then. There were no mortgages, so regular people couldn't really afford homes. And so for the most part, real estate was owned by only wealthy individuals. And the bubbles back then were caused by a lack of investment opportunity at the time, which caused many people to pour their money into homes, which is not that different from our current situation, to be honest. And since the supply of homes is very inelastic, meaning that the supply doesn't move very quickly, right? It doesn't shift to an increase in demand that fast. It takes a while to build new homes, right? So when there's a surge in demand, supply usually doesn't match up. And so this has often caused real estate bubbles in the past. So my point is that this bubble can go on much longer than anyone expects, especially if rates remain low. Governments are fully aware of the situation we're in, and I doubt that they'll sit by and let a major housing crisis to occur that would wipe out the retirement savings of an entire generation of baby boomers. Just look at how they reacted to the COVID crash. Lower asset prices will not be tolerated. And so I'm definitely not someone who is calling for a crash anytime soon, but I do want to point out the risk because some things are out of the government's control. So being patient is never bad, especially right now, given that interest rates are currently rising pretty quickly. But be aware that sitting on the sidelines for too long is also not the best option. So we'll have to see what interest rates do going forward and how that may affect mortgage rates. And I'm definitely keeping my eye on that. So that's my interpretation of this chart. To me, it indicates that we're in a housing bubble and that gap needs to be filled somehow, either with home prices coming down, rents going up, a combination of the two, or home prices going sideways for a while, which allows rents to catch up. Either way, I'm betting on that gap filling. But what if the situation has permanently changed and that correlation has broken? What if prices and rents never fill that gap? There's nothing to say that this relationship should hold forever. So maybe it's worth thinking about the possibility that we are in a permanently different situation. And to be honest, it's not a situation I personally want our society to be in, because if things are different this time, then it means that the cost of owning a home versus the cost of rent is unattainable to all but a few wealthy people who can afford the sky-high prices. If things are different, then we may be transitioning to a more feudal system where only the elite can buy homes. The idea that anyone can buy a home is definitely a more recent concept, and it's a good one, but it wasn't always like that. In the 14th or 15th centuries, you couldn't own a home. You often lived on the local landlord's land and you were forced to pay rent. So is this the type of world that we're transitioning to? I highly doubt that's the case, but it's definitely a depressing possibility to keep in mind. Although it doesn't line up with the current narrative out there coming from governments and central banks. The current narrative is definitely more in line with the redistribution of wealth rather than even more income inequality. So I don't think that will become a feudal society again. It's just one of the ways to possibly explain the disconnect that we're seeing between home prices and rents. So that's it from me today. I hope you guys enjoyed the video. And like I said, I hope I didn't deter anybody from getting into real estate at the moment. Just because we're in a bubble doesn't mean that you can't find great opportunities out there in the real estate market. Same for stocks. I'd say stocks are in a bubble as a whole, but there are tons of stocks out there that aren't in a bubble. And so I wouldn't tell someone to sit out of the stock market the same way that I wouldn't say to sit out of real estate. So I would be careful and be aware of the current level of prices and what may affect them. As I said, I think interest rates are key, and so we'll have to see if they keep increasing like they have over the past few weeks. So I'll be monitoring the situation and I'll make a video in the future if something big happens. So thank you as always for watching. Please be sure to like and subscribe. Stay safe in these crazy markets, and I'll see you with the next video. Take care.